Looking at the notable investment association sectors over this quarter, global emerging markets and Asia Pacific provided the strongest returns, bouncing back from a disappointing previous quarter. UK gilts rose 2.04% and sterling corporate bonds returned 0.83%. This quarter saw 2018 draw to a close, a year which began with high expectations, following several years of profitable mainstream markets. However, nearly all major asset classes lost value, resulting in a disappointing year for most investors. Market moves of this type are fairly common, and although events can be found to explain the change in market conditions, this is often an attempt to rationalize normal market volatility. One aspect of investment risk is measured through the use of annualized volatility, calculated by measuring the historical performance. Potential returns are illustrated by the 68, 95, 99.7 rule, which states that returns will be within the annualized volatility from the long-term average 68% of the time, within twice the volatility 95% of the time, and within 3 times the volatility 99.7% of the time. During 2018, the FTSE World Index fell 3.1%, which is well within its annualized volatility of 14.38%, from the annualized return of 6.67%, and is therefore entirely expected by our statistical analysis. The FTSE 100 fell more significantly with a loss of 8.73%, but this also remains just within the annualized volatility of 13.46%, from the annualized return of 4.39%. While 2018 contained many negative events, the magnitude of the market falls are arguably modest from a statistical standpoint. In fact, they could even provide evidence of global economic strength, withstanding events such as Brexit uncertainty, ongoing trade wars, 4 Federal Reserve rate rises, and numerous political incidents. Although investment markets did not respond as expected, company earnings increased and global growth remained positive, trends which are expected to continue into 2019. With valuations becoming more attractive and apparently fewer risks, most investment markets are beginning to recover their 2018 losses, further restoring investor optimism. The Federal Reserve had indicated 4 US interest rate rises in 2018, but as markets and some economic data weakened, the need for the 4th became debatable. Throughout the year, investment markets were concerned that the extent of these rises would threaten economic growth and, ahead of their December meeting, President Trump criticized the Fed for their decision. Despite no economic change, the Fed later softened their position in January, leading to the suggestion that their decision was more to demonstrate their political independence than based solely on economic analysis. In any case, this softening has been a significant factor in the recovery of global markets in 2019. The issue of trade wars between the US and China also showed signs of easing during the quarter, as friendly statements were exchanged and talks resumed. The wars have caused damage to both economies, so both sides will be keen to find a resolution. President Trump will wish to score a win to boost his falling ratings, whilst the Chinese will be keen to maintain low tariff trade with their largest trading partner. A period of 90 days has been agreed to delay any further tariffs whilst they attempt to reach an agreement. President Trump has also been embroiled in a battle with Democrats to secure funding for his proposed wall with Mexico, which led to the longest government shutdown in US history. Public opinion favoured the Democrat position, believing the wall to be a largely unnecessary expense. Meanwhile, in the UK, Theresa May and her government have faced motions of no confidence from both her own party and the opposition, as the initial withdrawal deal was voted down by a record 230 votes. One clear effect of the Brexit malaise has been the under-allocation to UK equities by international investors. In consequence, the FTSE 100 yield has risen to over 5%, despite interest rates of only 0.75%, offering a very attractive value, even accounting for the risks surrounding Brexit. In fact, the FTSE 100 companies blend around 60% of revenues from international sources, with 40% domestic, providing a hedge against the final Brexit outcome, with both sets of earnings being discounted. Regardless of the scenario, greater Brexit certainty could provide an uplift. US equity markets are on higher valuations and offer considerable currency risk in the event of a soft Brexit, where sterling would be expected to rise, decreasing the sterling value of overseas assets. The US equities yield is around 2.25%, with interest rates of 2.5%, so the valuation differential on this basic measure is far less attractive. We continue to expect a middle road soft Brexit to be the final outcome. As hardliners on both sides begin to feel the ground move to either a hard or remain position, they will gather around the compromise deal which, provided a backstop agreement is possible, appears to be the best compromise for voters and Parliament, even if it doesn't actually please anyone. In conclusion, 2018 felt worse than it was, with investor sentiment worsening throughout the year. However, this has led to a better opportunity for 2019, as equity valuations are lower, economic growth and company earnings did rise. We believe the most appropriate strategy is to maintain an overweight equity position throughout the current market volatility. Markets outside of the US are favoured due to better valuations, and the UK appears particularly attractive. We continue to hold a neutral weighting to Europe, as despite attractive valuations, long-term political risks continue to be a concern. Margetts Fund Management, specialising in managing risk-rated multi-manager funds.